$80 billion company gaining 11% in a single afternoon would be notable. When a $1.6 trillion company does it, something structural just changed. Meta Platforms moved 11.4% today on volume that was nearly 3 times its 90-day average. That is not retail traders chasing momentum. That is institutional money repricing a thesis. The question serious investors need to answer is not whether to celebrate the move, but whether the underlying data justifies a permanent reset in valuation, or whether this is a gap that closes back down within the quarter. That answer is more interesting than you might expect. Let's be precise about the catalyst, because the surface-level narrative being repeated across financial media misses the more important detail. Meta reported quarterly results that beat revenue consensus estimates by approximately 6%, which by itself would typically produce a 3 to 5% reaction in a stock of this size. 11% means the market was pricing in something beyond the headline revenue number. The real signal was an average revenue per user in North America, which accelerated meaningfully quarter over quarter, driven specifically by engagement time increases tied to Meta's AI-powered content recommendation systems across both Facebook and Instagram. When a company at Meta's scale shows re-acceleration in its core monetization metric that forces analysts to revise their out-year models upward, that's not a sentiment shift. That's discounted cash flow math. The second component that mattered was operating margin expansion. Meta has been running a capital expenditure cycle that worried a segment of investors. The company committed to spending aggressively on AI infrastructure throughout 2025 and into 2026. What the results showed is that the return on that spend is arriving faster than the consensus model assumed. Operating income grew at a rate that outpaced revenue growth, which is the directional signal institutional funds specifically wait for when evaluating a heavy capex tech company. The third element, management raised full-year revenue guidance. That is the line in the earnings release that triggers systematic buying from quant funds and index rebalancers simultaneously. Raised guidance plus margin expansion, plus ARPU reacceleration, is a 3-factor catalyst, not a 1-factor surprise. That combination explains why volume ran at 3 times normal. The move was not irrational. It was a repricing. This is where intellectual honesty matters, because the answer is not as clean as either the bulls or the bears will tell you. Let's start with the case that the move is justified and may have further to run. Meta's AI integration story is no longer a promise. It's showing up in the numbers that determine valuation. When AI recommendation systems drive higher session duration and higher ad click-through rates simultaneously, the monetization flywheel accelerates without proportional cost increases. That's operating leverage, and operating leverage in a business with Meta's revenue base compounds quickly into enormous free cash flow. The company's advertising business benefits from a structural tailwind that is specific to 2026. Small and medium businesses are increasingly using Meta's own AI creative tools to generate and test ad content, which keeps those advertisers on platform and spending rather than migrating budget elsewhere. Meta has quietly become infrastructure for a large portion of SMB digital marketing, and infrastructure businesses command premium multiples. Now, the case for caution, and this matters if you are thinking about this stock rather than just watching it move. At an 11% higher price, the forward price-to-earnings multiple re-rates to a level where any execution miss in the next 2 quarters will be punished severely. The gap up creates a high base from which disappointment becomes more expensive. Additionally, Meta's capital expenditure guidance for AI infrastructure remains among the highest in the sector. These are not sunk costs, they are ongoing commitments, and the returns from the most recent spending cohort have not fully arrived yet. Regulatory exposure in the European Union continues to create headline risk that has historically knocked 3 to 5% off the stock in short windows. None of these risks disappeared today, they were temporarily outweighed. Sophisticated investors don't ignore that distinction. They price it. Reminder, none of this is financial advice. Position sizing and risk tolerance are personal decisions that depend on your complete financial picture. If you're earlier in your investing journey, this Meta event is a masterclass in several mechanics that textbooks describe poorly. First, understand the difference between a catalyst and a reason. Social media will tell you Meta jumped because of AI hype. That is not wrong, but it is imprecise enough to be useless. The actual catalyst was quantified. Specific margin data, specific guidance language, specific ARPU acceleration. When you learn to read earnings releases looking for those three elements specifically, you stop reacting to moves and start anticipating the conditions that produce them. Second, volume tells you who is buying, and who is buying tells you whether a move is durable. Retail-driven moves on low institutional volume tend to mean revert within weeks. Moves confirmed by 3 times average volume with institutional block trades, visible in the tape, represent a genuine consensus shift among the participants who manage billions and model businesses in detail. Meta's move today had the volume signature of institutional repricing, not retail momentum. Those moves have historically held better than sentiment-driven spikes. Third, gap-ups in large-cap stocks present a specific decision framework that beginners often get backwards. Many investors feel urgency to buy immediately after a big gap because they fear missing further upside. Experienced market participants know that the highest probability entry is rarely the day of maximum excitement. The pattern worth studying is how a stock consolidates the gap over the following 4 to 6 weeks. Does it hold the new level and build a base, or does it fill the gap and return to prior levels? That consolidation period reveals whether the institutional buyers who drove the initial move are adding or distributing. Watching that behavior without acting impulsively is itself a skill, and it's one the most disciplined investors in the world practice on every high-volume catalyst event. The larger lesson embedded in a day like today: large-cap technology stocks can produce double-digit single-day returns when multiple fundamental signals align simultaneously. These events are not random. They are the output of specific, measurable conditions. Learning to identify those conditions in advance is what separates investors who build compounding wealth from those who simply watch tickers. We opened with a simple question. Does an 11.4% move in a $1.6 trillion stock reflect reality or euphoria? The data says it reflects a genuine fundamental shift: margin expansion, ARPU reacceleration, and raised guidance arriving simultaneously. But the gap also creates a higher bar for every quarter that follows. The question this raises for the next video: Meta is not the only AI-heavy platform running this playbook right now. Which company is closest to its own version of this inflection point? Subscribe to Synthetic Alpha so you don't miss that breakdown when it drops.